So we are now turning to the first panel of our annual conference, and I would like to invite Miss Victoria Saporta back to the stage, who will be moderating this next discussion, and I'll allow her to introduce her panelists after she gets seated.
I'm very happy to be able to moderate this first panel on supervision in a digital era. Our panelists, as you can see from the names, and are across a membership, and they will explore the current readiness of the supervisory community to deal with emerging trends, such as the resilience of the sector to cyber threats, questions around the fair and ethical use of data, artificial intelligence and machine learning, the opportunities and challenges of digital financial inclusion, and the impact of fintech and big tech and third-party cloud providers on traditional market structures. So to do all that, we have Eric Cioppa, who is the president of National Association of Insurance Commissioners and Superintendent of the Maine Bureau of Insurance in the US. Eric. We also have Hern Shin, Assistant Managing Director for Banks and Insurers at the Monetary Authority of Singapore. Hern Shin is also a member of the IAIS Executive Committee, and she leads the fintech workstream network that we have set up. Godfrey Kiptum, Commissioner of Insurance and CEO of the Insurance Regulatory Authority of Kenya, also a member of the IAIS Executive Committee. Maritza Kuna, Legal Advisor in the Policies and Legislation Department of the UAE Insurance Authority. So welcome to our panelists. I'm not going to sort of delve into the work that the IAIS has done in the field, because I think this was covered by earlier remarks and speeches, but it suffices to say that this is a big focus of our work. I mean, recent products, as Jonathan said, was last year an application paper that actually surveyed supervisory practice, a stocktake paper on, from a supervisory perspective on cyber resilience, on how we supervise that. There was, and now, as has been flagged, we have a group of our colleagues with some expertise in this area that is actually looking at the other side of the coin, not how our firms are going to be resilient to cyber shocks emanating from the outside, but how our firms can use their business model to underwrite cyber, and the opportunities and risks that this raises from a supervisory and financial stability perspective. And from that work, we should be able, at our meetings in February, to develop our future focus on the IAIS on this front. And we also issued a paper which I commend on supervisory issues, an issues paper on big data a month or so ago. So this is pretty recent. So these are recent products, but as we have completed the 2015 and 2019 agenda, really we're beginning to focus more on these issues. So I know that kind of this conference so far hasn't been particularly interactive. So rather than listening to us, I want to start with a polling question to ask the audience what they think is most important, particularly the supervisory audience, but those who are not supervisors or who had been supervisors in the past, please also try to answer this question. So the question is, in terms of digital innovation in insurance, what keeps supervisors up at night? Impact on market structures and ability to provide effective oversight, use of new and big data and consumer outcomes, inclusion of vulnerable consumers, cyber resilience, or other. So we need to use the Mentimeter to actually collect responses. $31. Gosh, cyber resilience is winning. It's a close race between impact on market structures and use of new and big data. Okay, so Hern, Shin, would you, and Maritza, would you like to briefly reflect on these responses from your perspective? It looks as if cyber resilience is winning the race.
Me first or Han Shin?
I mean, I'm going to ask you to speak on cyber, but whoever wants to reflect, from your perspective, Eric, do you agree with these results? Would you rank it this way yourself?
That's a good question. Do I have to choose? It's a lot of things that keep me up. I mean, I was at one panel, I think it was in Argentina, when someone had asked an insurance regulator what their job was, and his response was, I'm a paid professional worrier. And I think when I look across the spectrum, I mean, I worry about all those. I worry about the impact of big data on consumers. Cyber resiliency, I worry, there's a couple issues there. There's one, insurers, the data breaches that insurers have, when we look at insurance companies, we want to make sure this is a C-suite, this gets the attention of the highest levels of the company. Are they paying attention to their cyber resiliency? Are they paying attention to, if they're migrating to the cloud, have they thoroughly investigated that? Because the insurance companies live off data, and if that data is impacted, it could cause, the insolvency of the insurer. So at the NAIC, we're doing a lot with our examination authority. Most of us are, when we examine companies, are hiring IT experts, trying to do penetration analysis, trying to make sure they're tabletopping, because we had a big data breach of a large health insurer. Over 70 million policyholders had their data lost, including mine, which got my attention. And during the exam, we hired a professional firm to go in, and his response was, there's two sorts of firms. There's the firms that have been breached and the firms that don't know they've been breached. So we operate under the assumption, okay, if a firm's going to be breached eventually, have they planned for that and have they tabletop for that? Because that is so critical, the response. Are they actively monitoring for data breaches? And once they discover a breach, do they have a plan to deal with it effectively and immediately? And that includes notifying the regulator, of course, notifying the consumers, and how they're going to deal with the breach. I mean, that's so critical these days. And breaches, I think, have gone up, I saw a statistic, by 61% in the last 5 years. So that's incredibly important. And then the other thing we're looking at insurers when they're underwriting the product, when they're selling cyber insurance. The prior speaker talked about how important it is for insurance companies to offer this product for protection, for risk transfer, for businesses. I think that's incredibly important, but also as a prudential regulator, to insurers understand what they're underwriting. Are they pricing it appropriately? Have they understood what we call silent coverage, silent exposure? Do they understand what that could be? Have they quantified it? Because that truly could have a huge effect on companies. So again, we look at cyber risk, how they're managing their data, how they're protecting their data, and two, for the underwriting of those companies selling it, do they understand what they're underwriting? Have they thoroughly quantified it, and what are their underwriting guidelines, and how are they prepared for if they get some, in the United States anyways, some significant court cases which increases their exposure significantly? Have they accounted for that?
Thank you, Eric. Now I turn to another topic, which is insurers and consumers face a number of opportunities and challenges from the increased availability of data from traditional news sources. So, Hern, Shin, I'd like to hear your perspective from Singapore on this issue.
Thank you, Vicky. So I wasn't surprised by the earlier results because, that's really fundamental 101. As firms digitalize and make use of digital channels more, really they need to ensure resilience. Otherwise, customer confidence won't be there, and those channels would be useless. But turning to a slightly different topic, one trend that nobody can ignore in recent years is the increasing use of artificial intelligence, machine learning, big data analytics in the insurance business. And this has brought many benefits to consumers. Let me highlight just two. One is greater convenience to consumers. So if you look at even the simple area of making a motor insurance claim, can be a big hassle, can be from days to weeks. But some insurers now, making use of image recognition technology together with big data analytics as well as AI, are now able to do accident damage assessments a lot more expediently. So customers can make use of your mobile app, take a picture, send it to the insurer immediately, and the image is processed and analyzed to a high degree of precision, allowing almost instantaneous assessments. It prevents risk leakage, which is good for consumers as well as for the insurer. So that's one area, really much better convenience. The second area of benefit, I think, is finer pricing as well as inclusion in insurance. So real-time health data analytics has allowed insurers to cover some previously considered uninsurable risks. One example would be life and disability insurance for diabetics. So there's an insurer that does this, and not only they are able to include such insurance in their product offering, they're also able to lower premiums using dynamic algorithmic pricing based on consumers' response to nudges like take your medicine. So that's great for consumers. And of course for insurers, if you are better able to identify risk, you can manage risk better. Better services to your consumers really means better business as well. So of course everybody is rushing into this, machine learning analytics business. But there are associated risks. And two things that keeps coming up to us is one, how do we know insurers are using non-biased, representative data that will not result in discriminatory outcomes for consumers? Second is some of these machine learning models are not as easily auditable, and the models are not as easily verified compared to the linear models that we're more familiar with. So it's ignited this huge debate. Are these black boxes trustworthy? Can we really use them, right? So I suppose the question for us is, as an industry, as a society, how do we benefit from machine learning, AI, big data analytics, given all these challenges. And the industry somehow agrees with consumers. They say the regulator must have a role, to play in this, to police this. We don't disagree. And in Singapore, we think that early signaling and early guidance can help the industry develop in a very healthy way. So we collaborated with industry a year ago, in fact in early 2018, and came up with a set of principle-based guidance for industry to refer to when they're using AI, which is artificial intelligence and data analytics. So we call it AIDA for short, AIDA. So this promotes 4 elements. I'll just very briefly go through them and to share with you why they're important. The first element is fairness. And this really requires insurers to make sure that the AIDA-driven decisions that they use are explainable, accurate, and justifiable. So it tries to avoid spurious or biased relationships picked up by bad modeling or bad data to discriminate consumers. Second area is ethics. It requires insurers to ensure that even as they use AIDA, their current levels of ethics, standards of ethics and codes of conduct are adhered to. The third area is accountability. Insurers has to be transparent in their use of AIDA, and this means that they have to, in accountability, it requires insurers to really be responsible for and to own their AIDA-driven decisions. So for this to work, they will need internal governance and approving authorities for the use of AIDA, and consumers also must be provided with the channels to correct their data and to query, AIDA-driven decisions. And then finally, on transparency, insurers need to be transparent how they're using AIDA. They need to disclose proactively to customers how they're using data and how this affects policyholders. Of course, this doesn't operate in isolation. It operates together with our Personal Data Protection Act requirements that requires insurers to ensure that there's consent and customers know what they're consenting to when they collect, use, or disclose data. So we are sort of 1 year on from the issuance of these, what we call FEAT or FEAT principles, and we realize that it's very difficult to implement. So Vicky, if you ask me, are we ready? Well, not exactly. Insurers ask us, what do you mean by explainability? Does it mean I cannot use a black box model? Insurers also ask us, what do you mean by discriminatory? How is that different? And do you distinguish it from data-driven risk differentiation? And I suppose the most difficult challenge insurers and other financial institutions tell us is, how do I assure myself and you as a regulator and my customers, finally, that I have adhered to these FEAT principles? So we know we needed to take the next step. So we've just started a bold experiment. We have formed a consortium of 14 partners, including banks, insurers, a consulting firm. This consortium is called Veritas, and we're trying to get together to answer the question, what does it mean to systematically disadvantage a group of policyholders when you do pricing, right? And if we can agree on that answer, can we develop open source codes that can be used to test against AI developed by financial institutions to check that there is no embedded inherent biases in them? Will we succeed? We don't know. It's a very bold experiment. I'm sure we will learn a lot from the experiment, so watch this space. We hope to be able to update you in a few months where we are, but we also believe that collaboration with the industry will get us far in this space. So we hope to learn from everyone in this conference and in the conversations that follow how to do this better. Thank you.
Thank you very much, Han Shin. And now to our second polling question. Can we put it up, please? How should supervisors respond to supervising in a digital era? Build capacity and skills, regulate key infrastructures like cloud service providers, good luck regulating Apple, facilitate innovation, enhance consumer data protection. Any guesses from the panel? Which one would win?
Build capacity and skills.
So Eric is betting for 1 and 3.
Number 1.
Very close. It's interesting. The facilitate innovation from a regulatory perspective is interesting. And as we know and we have heard already, different regulators have different approaches to sandboxes. Some don't have any sandboxes. They have sandboxes of different colors. But some regulators don't even have innovation as part of the mandate. There might be trade-offs between different elements of the mandate. So it's interesting from a supervisory perspective, the innovation. How do we manage to facilitate innovation while looking after the risks? So let me now turn to the next panelist. So Godfrey, as you know, one of the biggest changes for supervisors in this new digital era and is how we interact with the industry we oversee and the consumers that are served by that industry, and the speed of innovation, both in terms of product design as well as the types and numbers of new players involved, has introduced risks that challenge traditional approaches to our key regulatory objectives. Could you share the innovative approach Kenya has taken to facilitate technological innovation to enhance financial inclusion while maintaining high levels of consumer protection?
Thank you, Chair. We've put in a number of initiatives that would open up the insurance field and also access to many other people who currently are underserved or can't access insurance services. As you very well know, many people in those parts of the world, especially in the developing countries, are just one step back to poverty. So insurance has been used as one of those mechanisms to ensure that the poverty is reduced and that people don't go back to poverty. So there are a number of initiatives that the authority has put in place to ensure that many people are brought in place and those kind of things are stopped or reduced. So the authority has, over a number of years, introduced a number of products, weather index insurance products, Kilimo Salama, if you have heard about it. This is a product that is based on an index. So once the weather is not as good as it was supposed to be, then payments would be triggered automatically, and the payments would be done via digital platforms. You most likely have heard of M-Pesa or mobile money that is currently being used in Kenya and many other countries within the East African region, which has really taken root. So the money would be dispersed automatically to the farmers. They get it on their phone, and they don't have to fill any claim forms. They don't have to do anything. You just find the money comes once the index level is reached. This has also happened with livestock. When the fodder range is below a certain level, the payment should be triggered and the money would be sent in the same manner to livestock farmers, wherever they are in the country, once the fodder levels falls beyond the agreed level. So that happens. We also have a number of other initiatives through Bima Lab or Bima Box, and Bima is basically a Swahili word that means insurance. And in this lab, we are currently receiving applications to join, and we are going to encourage digital insurance. That is, you do distribution on digital platforms, pay claims digitally, disclose the coverage that you are doing via the digital platforms. Even consumer complaints would be launched through such mechanisms and will be addressed by the authority. So this is work in progress, and we expect that it will be coming on board by beginning of 2020. And the authority is very keen to make sure that this is done. The law has been appropriately adjusted to allow this. We also have a number of initiatives on microinsurance, or insurance that can be accessed by people who are underserved and people who cannot afford to buy conventional insurance products. So this is something that we have encouraged, and we also will be running it in the coming year. And this will basically be low-value insurance that would meet the needs of those people who currently are excluded or underserved. So we think this would really contribute to insurance penetration, and also in terms of socioeconomic development in our country. And we hope and pray that these things take root, and we will be encouraging other people to join us within our markets and the region, so that we can build on it together and achieve inclusion for sustainable development. Thank you, Chair.
This is very, very interesting, and it demonstrates how technology can really benefit society. So, turning to MITSA, could you provide us with a perspective from the UAE, whether you think the current sectoral and entities-based approach to supervision is effective in the new era? Or do we need a different approach, an activities-based approach? And what do you think that might mean? We heard earlier Tim, our keynote speaker. It's something we hear often, same activity, same rule. So could you offer your views on this?
Thank you. Insurance supervision has never been so exciting. At the same time, it's becoming extremely challenging. In the time when a person can get insurance coverage from multiple sources, from digital platform, third parties are involved. Now, the traditional entities-based approach usually dealt with liquidity and capital. Now, with third parties involved, that will not do the job anymore. So now supervisors are required to work outside their comfort zone. They are required to get involved with undertakings that are usually under their remit. Therefore, we cannot do that alone. In my opinion, it has to begin, first of all, with building knowledge. It's not a secret that the industry leads innovation, and there's nothing wrong with that, and we can learn from them. We have to build capacity in terms of attracting talent. We need to get involved with dialogues with academics. We need to work to begin with how these innovations work. After we reach that state, I think it would be important to be flexible. In other words, we want to be embracive of innovations. We want to be forthcoming. At the same time, we have to maintain a delicate balance between being embracive and maintaining the rights of the insured to be treated fairly and at the same time we want to enhance competition. Therefore, all these elements, when you put the equation together, I think that the entries-based approach will no longer serve the purpose. We as supervisors are now in need for one another more than ever. We need supervisory colleges more than ever. We need international cooperation more than ever, because we're talking about a startup being in a certain jurisdiction and the insurance carrier being on a different jurisdiction. Therefore, I think that we as supervisor might consider entering into more MOUs with other jurisdictions, or perhaps rethinking or reevaluating our existing MOUs and the scope of such cooperation. Definitely getting involved in supervisory colleges with other insurance supervisors and non-insurance supervisors, as probably it's just a matter of time where certain issues rise with telecommunications supervisors are required to intervene. Therefore, definitely the approach of an activities-based approach should be considered by us as supervisors, and we should be able and willing to take the necessary steps to get more involved in dialogue with market participants, with academics, in order to enhance our toolbox with more tools and more capabilities.
Thank you very much, Maita. Can we now turn to the third polling question, please? What do supervisors need to be most ready for the digital era? You need to use a word cloud answer. Talent, skills, capacity, flexibility, knowledge seem to be winning the day. Just before we open up to questions on the audience, we can see how, 163. May I ask the audience in your own organization, I can speak about my own as well, what sort of skills and how have you approached the skills issue and capacity issue in dealing with these issues?
The list, because when I started 30 years ago, our exams were just they were auditors. They ticked and tacked a ledger sheet. our actuaries looked and did rate filings. Now I need data scientists. I need people who can evaluate complex models, complex AI issues. And for a small supervisor in a small state like Maine, it's difficult to attract those talents. So I think one of the things we're doing at the NAIC is looking to pool resources and work together and leverage every state together to come up with a common methodology, a common way of looking at models, looking at AI issues, because let's face it, most supervisors are not going to be able to compete with the private sector to hire the talent you need. And things are moving so quickly, so fastly in terms of innovation. The use of big data is driving a lot of the underwriting now, and we need to evaluate it. Shin talked about, discriminatory results in underwriting. I need data scientists. I need people who can evaluate models to do that. And I think the only way in the United States is if we pool resources and you approach that model, because it's a significant issue. Times are changing, they're changing quickly, and we need the skill sets to keep up so we can protect consumers.
Interesting. Shin?
So we've taken a variety of approaches. In the first instance, we would hire specialists from the market and we'll put them in a different department, because if you're doing this as a side job, usually it doesn't get sufficient attention. So we set up entire units, even though there was no increase in headcount. So we had to literally rob Peter to pay Paul. We would cut resources in other functions within the organizations to set up a new AI office, to set up a new digital analytics group. And apart from that, after getting in the experts and their teams, we would also do quite thorough training ground up. Every person on the ground, there's 3 levels of education, from the basic to the intermediate to a expert or super user. So even senior management like myself gets put into a Python coding class. It's not to help us become Python coders overnight, but so that we understand. We've gone through RPA training as well, so that we understand what the staff are doing, what are the difficulties and pitfalls in each of these areas, so that we can ask the right questions when some of these things come up to us. So it's quite thorough, end to end, and from hiring to training to mindset shifts as well.
Interesting. Godfrey?
Yeah, we've created a team that is looking at issues of innovation and technology and digital distribution and data analysis. And we have also trained a lot of actuaries in the recent past to look at the issues in the market. And we also do outsource when we don't have the required skills within our authority.
Thank you. And Marta?
I think that since now we have to deal with issues such as pinpointing that fine line that segregates our duty as supervisors from the duties of third parties. In other words, what falls under our jurisdiction, what doesn't. And in order to reach that state where we pinpoint where third parties start undertaking insurance matters that requires our licensing, then we need to have the algorithm technicians or expertise in order, for instance, to determine, is this startup really conducting an undertaking that requires our license, or does it not? Does this thing falls under the definition of an insurance undertaking, or does it fall under the definition of just marketing or price comparison websites? So in order to be able to reach that state, I believe that we might consider attracting talent that are capable of determining when a third party is conducting, weighing the risk, or setting the premium, which falls under the definition of underwriting. So in order to reach that state of drawing or pinpointing that line, I think we need algorithm analysts and technicians and programmers?
Yeah, thank you. I mean, we at the Bank of England with our regulatory hat on, because obviously we've done things with our payments and central banking hat on, but we have set up within the Bank of England Financial Innovation Hub, very much along the model of pay Peter to rob Paul. That is, we've prioritized that without changing our budget, which actually scans the horizon of all developments and then uses the expertise around the bank to delve into particular issues. But basically, its role is to stay on top of all developments out there that could be relevant. And then we have set up, we used to have, we continue to have an advanced analytics area with data scientist type of people, or very sort of quant types. That help us gain efficiencies in doing our analysis and using big data for all our functions. And we are repurposing them to actually deliver on a RegTech, SupTech vision, which was touched upon earlier. And in terms of supervisory policy so far, in the area of cyber resilience and operational resilience, it's more setting out what our expectations are to the companies, and then asking them to manage and set up governance frameworks for that. But it is interesting, the variety of actual approaches. Thank you. Sort of Hern, Shin.
So maybe I can add briefly in two areas. In a new area of expertise, we found it extremely helpful to work with the industry, because very often as supervisors, we're not at the forefront, but we have the benefit of seeing good developments everywhere. So forming industry groups, learning from them, sometimes at very senior levels, getting a group of panel to come in to give advice to senior management and board, that has served us very, very well.
Yes, exactly, and we took the same approach. Tim Adams earlier last year when Hugh Van Steenis wrote its report on future finance. It wasn't only about digital; it was about other areas such as sustainability. But that was particularly by consulting all sorts of industries and all sorts of actors at very, very senior level. But I do agree, we also going to, very similar actually to the approach that you set out, are going to set up an industry group to try to look around how we deal with ethics or other regulatory issues around machine learning and artificial intelligence, but not the open source code idea, the more how to do it that way yet.
We don't know whether it works. It's literally a bold experiment.
Yeah.
Check in with us half a year later.
We can steal the idea. So with that, may I open the floor for questions? Questions? Nobody has a question to the panelists? Ryan.
Hello? Okay. One of the points that both Vicky and Hern and Shin made was that as they've kind of been going about trying to find resources to address some of these new issues, you've had to rob Peter to pay Paul. How have you gone about deciding who gets robbed?
With a lot of blood, sweat, tears. No, but generally this is decided at senior management level. We do an organizational prioritization. And sometimes it involves ground-up resource estimation as to what are the different functions that we can do less in. Yeah, there's no easy way. Essentially, you sort of say, you know, what can I deprioritize in order to put more resources into this?
We have done, by the way, I didn't ask that. This was Ryan Workman from the NAIC who asked the question. If for any following questions, please state your name. But Ryan, we have adopted exactly the same approach. We have a very senior level, governor level reprioritization exercise, and we staff up our priorities, and this has been actually a priority for the past 2.5 years, with areas that are no longer deemed to be priorities, and you know, we deal with any skills mismatch through attrition and such techniques that resource management usually uses.
Maybe if I can just briefly add, the other thing that we're trying to do is also to focus a lot on RPA and automation, because as you make certain manual intensive job easier, you actually free up resources. So when we free up resources, this gets put into higher value adding jobs as well as new areas of priorities. So in the initial years, it's painful because as you're building automation, you actually have a bump up in terms of the required resources. But once that starts delivering value, you find that it starts giving you a bit more wiggle room in terms of shifting resources around. So that helps, but it will be a journey.
And I mean, another example of these efficiencies that supervisory authorities can get with the use of technology, which actually can save resources for something else, which is an investment activity that can save resources for the future, is that we recently found. So we have a longer-term project to completely automate a rule book. So it's basically a rule book is much bigger than the size of War and Peace, Tolstoy's War and Peace, thousands of pages. So we would like, so what we've done is it's now machine readable. So you can search it within seconds. And we are going to be releasing the code to everyone who can want to use it and make, because it's now machine readable. But what we have found with this is that we have saved regulatory resources because the rules are so voluminous. You know, we have Solvency II, capital requirements, we have our own rules on top of it, etc., etc. If we want sometimes to look at a particular issue thematically, for example, how many regulatory thresholds at different levels do we impose in our rules? Such an exercise, I asked my team to answer 3 years ago. It took them 3 days, and they came up, it was how many regulatory thresholds do we have in our rule book? They came up with the answer of 12 after 3 days. We then make the rule book machine annotatable. It's not quite readable, forgive me, for my specialist, and we asked the same question. It took 2 seconds, and the answer was 85. So it actually really, these small things, and I have a number of examples where analytics can help save time for regulators as well.
Vicky? Oh, thanks.
Yeah.
Hello. Hello. Hi, I'm Bernbaum with the Center for Economic Justice. It's a consumer organization based in the U.S. So as you learn more about big data analytics and AI, you understand that it's grounded in large volumes of very detailed data about consumers, the environment. So when it comes to supervisory practices, and you try to take advantage of these big data analytic techniques and AI tools for monitoring consumer outcomes, what are your strategies for obtaining data that's needed to fuel regulatory AI, regulatory big data analytics? What initiatives have you embarked upon to start capturing more granular data to fuel your ability to automate and improve your analytics of consumer outcomes?
Does anyone want to take that? Yes, Maritza?
Yeah, the insurance authority in the UAE recently launched its digital supervisory platform, which is the first of its kind in the Middle East. We are very proud of it, and it enables us to obtain and generate instantaneous reports about the possible accumulation of risk and identifying trends. It enables us to get information about licensees that are up to date in terms of solvency, technical provisions, premium, and so forth. Of course, all licensees are required to log on and present their data on the supervisory platform. A special part of the platform is also designated to anti-money laundering and terrorist financing. Such a platform is going to help us to intervene swiftly if we're able to locate any kind of breach or non-compliance with certain requirements in that regard. So definitely now it's all about data and the need to get that data in instantaneously. Let's say the conventional ways, annual statements, quarterly, and so forth are good, but in the time of digital era and where things can snowball really quickly, the need for the ability to get the information and lots of it swiftly is something that cannot be overlooked. Thank you.
Thank you, Maritza.
So maybe if I can add a slightly different perspective, our approach is quite different in that we do not actually try to collect a whole swath of data to interrogate it to ensure fairness. Our approach has always been to rely on the financial institutions' own internal governance and policies as the first line of defense. And so we would go into the institutions and say, show us how do you ensure that you have been fair, how do you ensure that your models are explainable, justifiable, accurate. We look at their general governance, we look at their processes and their controls, and then we also do testing when we are on the ground. But on an off-site basis, there is no sort of active surveillance by collecting industry-wide data to ascertain this. So it's just quite a different approach for us.
And I would just add, I think it's also a matter of training your people, your analysts. It's no longer, you can't think of just one data source or one checklist you have to do when you're monitoring the markets, whether it's from a prudential standard or market conduct. I think you have to train your analysts to think broader, think on their feet, and think, materiality, risk focus in terms of what issue, what questions they have, and think broadly. It's really a way of thinking for our people, making sure they have the training so they can really look and what is the problem they're trying to what's the question questions they're trying to answer and think broadly, not think in terms of narrow scope, the annual statement, like in the United States for financial data or market conduct. You want them to look further and be more expansive in consideration of what's out there in terms of data.
Excellent.
Thank you for the panel. John Huff with the Association of Bermuda Insurers and Reinsurers and a recovering regulator. So let me ask you and point to Superintendent Cioppa's point about the skill sets changing for regulators and the survey that said one of the most prominent needs for supervisors would be talent. So in this fairly robust economy and this need for changing skill sets, what are your strategies to bring more talent into supervisors' offices?
Well, John, I'll start off. I mean, as you know, that's why I think with the model I described, where we pool resources and talents among the states using the NAIC, is an effective model, at least under our system. Because again, the idea that states are going to be able to attract the top-notch data scientists is probably not feasible. But however, by leveraging the NAIC and the different states' approaches, I think we get to a very good result. And we always have the ability to hire consultants when we have that one-off problem. We need really highly, technical help. I think that model has proven effective in the United States.
So I think the regulatory job is not that bad, one that we can't compete. We can't compete in terms of pay, but I think we can compete in terms of philosophy and in terms of exposure. The people that join us are those that are quite happy to work quietly behind the scenes to make sure things work well for other people. And, there are data scientists that, fall in that category. But we also have quite an interesting range of work for them to do. Standard setting is something that you can't do within the industry. We get to do that. For young, bright ones, when they join the industry, they get to see one small sliver for a long time. But young ones that join us gets to see across the industry, across different markets, and they meet with very, very senior people in the industry as well. So it's a different kind of exposure. Not all stay for the longest time, we know that, but we find that sort of exchange of talent with the industry is very, very helpful as well. So there has been the need from time to time to stretch our pay lines. And when the need arises, we try to do that. But we don't need everyone. We need a effective core team, and we've been able, thankfully, to hire one.
Yoshi?
Yoshi Kawai from OECD. Just a question for culture of regulators and also this agility, needs of agility. When we make a rule as a regulator, and particularly international organization, it takes time with good reasons, with good process, a good proof and consultation. But when we discuss this issue, agility of the regulators is extremely important because industry moves so fast, as Hern Shin's example mentioned. For example, ethics is a very important issue, or oversight of AI is a very important issue, or data protection issue is very important. But when we want to make a very concrete, good regulation, I can imagine it takes very much time, and specifically more international field, it takes more time. So how do you create good law with good speed? So it's a big challenge as an international good law, but also national good law. How do you cope with this agility or flexibility challenge as a regulator?
So maybe I take a first stab at it. I think the basic risk buckets are sufficient to capture a lot of the risks that all these new technology, even sustainability, right, even in green finance or in innovation, it impacts the firms in different ways. So for example, reputation risk, that's a hook that we always have. So the first step that we always do is to build awareness in the market. Hey, we think that there's this risk, have a conversation with the market. If we can't put in a rule in place, sometimes it's because whether it's a lack of awareness or the market has not fully developed yet and you don't want harden rules to crimp the development of the market. You might get the industry to set some self-governing rules, or you might put out some guidance for the industry, high-level principles, which was what we did with FEED. It's not legally binding, but it marks a line in the sand that when we go in for supervision, we say, hey, how do you show that you've been responsible in this area? And if you have not, we think there might be reputation risks. And that's something that we keep an eye on, where we can have a conversation on, and there are supervisory tools around them as well. And it's only when the industry sort of develops to a more mature state and you actually know how you want to regulate, and that there are some baseline requirements that are relevant to everyone, that's when a rule may become relevant, and you might then get into the whole long, arduous process of rulemaking.
Yeah, I agree. I think once you see an emerging risks, my personal view is as supervisors, you should not jump to rule writing and standard setting. Standard setting is not the solution, or rule writing to everything. You should, though, act as a supervisor quickly. And if you don't have the right practices, you need to develop them quickly, and you can write supervisory reviews. I mean, in the language of IAIS, it's mostly application papers of how you go about supervising, because very, very often the overall framework, you're just trying to manage certain risks. So you will have in your rules sufficient authority to get them to, because they will fall under your rule-making framework. But you need to actually tell them what you expect to see when you go out to supervise from a prudential perspective. I mean, I think the area of ethics is a tough one because, as Shin said, you start with principles. I mean, we know sometimes the supervisory community tells us we don't like rules, gives us some principles. Detail is not necessary, and then you try to do it with principles, and then they don't know exactly how to interpret them because there are risks to senior management and to people to sign off on them if they have misinterpreted them. And then sometimes that takes you to a very detailed path. The important thing is to have a supervisory framework to manage the risks. Okay, we have completed our panel. And thank you very much to the panelists for what was a very interesting discussion. I hope the audience agrees with me. Let's give them all a round of applause.